Thanks for joining us, everybody. I'm Ashley with Fortress Brokerage Solutions, and I'm bringing on Elena Castor today to talk to you about the long-term care state of the market for 2024. She's going to be going in depth on some conceptual pieces for you guys today as it relates to what we're seeing, where we're heading, and some small business ideas. So without further ado, Elena, take it over.
All right, thanks for having me. And thanks for being here, everyone. Appreciate your time today. There's a lot to cover, and I want to keep this in a timely fashion for all of you. So if you have questions, I'll ask that you just put them in the chat. And then once we get towards the end, unless Ashley, you think an appropriate moment, we could answer them, while we're going. Happy to do that too, but sometimes it makes sense just to hold those off to the end and then answer everyone's questions. And also, we could put those questions out in questions and answers as one group email that Ashley can get out to everyone as well. So let's get started. I'm Elena Castor. I'm the Director of Member Services here at Advantage Insurance Network. And it's been a wonderful market to be in this product segment with the asset-based long-term care plans. So I'm going to give you a high-level overview before we dive into things of what the market has been like. For us, we've been doing this for probably less than 9 years now, and the growth that we see year after year has been significant. And of course, consider the pandemic last year. There are some upset factors involved that changes things, but despite those things, we are still on track to hit our pre-pandemic goals. So a great market to be in, and there's something to be said about the demand for long-term care planning, going up in this product segment. When we look at what's going on, this ongoing continuance environment that we've been in with baby boomers turning over 65 every day, it's a very large number of, over 10,000 people every day turning older in that baby boomer market. Are they our only target market? Of course not. I work with a lot of clients in their 50s. And depending on the influence that they've had in their own family and experience with the long-term care event, I've done planning for people in their 40s. So to me, there is no, perfect age for someone to start their long-term care plan. I think it's any age that there's a fit for it. But what we're seeing out there is the demand for long-term care services continues to go up because we are dealing with that aging population. Costs for long-term care, depending on the state that clients live in, can be 2%, 3%, maybe even a little higher, depending on what states the clients live in. Your border states are going to be the most expensive, like California to New Jersey. Very expensive states to receive long-term care, particularly skilled care in a facility. So we're talking 6 figures. There's also, those clients who might be your high net worth clients who may require concierge level services. Well, you can kick that number up to a higher 6-figure amount for concierge level services. But all that given factors, and there's probably a few more factors I won't go into, that are driving more need to do planning, driving more need for us to have the conversation with clients. Now, I want to get in front of you here a list, and it's not all encompassing of the key players in the market. These are the key players for us here at AIN, but again, not all encompassing. And I've separated those, as you'll see, by our life component or life chassis asset-based LTC plans versus the annuity base. They both have their niches, if you will, or their fits in a particular target market. For example, the annuity base, I'll start out with first. One America offers a suite of fixed and performance type of asset-based long-term care annuities. Global Atlantic offers a fixed annuity there. The niche here is that sometimes clients don't always qualify for the life component plans because underwriters are looking at mortality and morbidity, where on the annuity side, they're only concerned about morbidity. Is your client going to go to claim pretty quickly because of a bone or back disorder or severe arthritis that they can no longer use their hands or feet? So very different in that aspect. We have a niche there. Also, anyone above 65, closer to 70, we can actually get more leverage for their premium dollars on an annuity-based long-term care plan. So keep that in mind, kind of a niche positioning product, if you will, when we look at the long-term care annuities, the asset-based long-term care annuities specifically. Reverting back to here on the life side, we have Lincoln with their suite of MoneyGuard, fixed and a performance-based. We have Nationwide with Care Matters, Securian with Secure Care, and One America with Asset Care. All these carriers bring something niche to the table. One America, up until very recently, was the only carrier who could offer a joint design. So great leverage or bang for the buck for couples looking for coverage for long-term care using the One America joint design. They also still are a niche for the unlimited benefit duration. If you're familiar with the different durations that are available, it could be a 2-year, 3-year, 4, 6, 7, 8, unlimited benefit duration. That's their niche there. And a lot of those types of policies do get sold in the marketplace. What else could I point out here? Just different niches from elimination periods that all work differently. I think Securian, even though they have a true 90-day elimination period, is a niche because they start the clock for that deductible period, if you will, when the doctor writes the plan of care, where the other carriers start the elimination period on the first day that clients receive long-term care services. Very different, more advantageous to have it start when the doctor writes the plan of care, because we know most people who go to the doctor get their plan of care written are already getting help in the home by family members. And because of that, that turns out to be an advantage by the time they set up their actual long-term care service company of choice to come out and help mom or dad. You could have already lost 30 to 60 days in that process. So now they've already met the elimination period or part of it or a large part of it without paying any expenses. So very advantageous with the securing elimination period, but Lincoln being a true 0-day elimination period carrier, while Nationwide does what we call a retroactive. Somewhat like a zero, client just has to initially come out of pocket and then they get reimbursed at claim month 4. So those are the main carriers for us. I'm going to move on here because I want to dig into what we've been seeing, call it the past year and a half, starting with product changes. I'm going to dive into and spend some time on long-term care legislation, but I'll save the best for last, as they say. What we've seen up until a year and a half ago, we were in a very consistently low interest rate environment. And that changed as of about 18 months ago. We started seeing interest rates come back up. And because of that, we started seeing pricing decreases because these products are kind of driven, if you will, in pricing or sensitive to the interest rate environment. Because interest rates have slowly been coming back, we've seen anywhere from 14% to 25% pricing decreases with the various carriers that I just showed you on the previous slide. With that, we've probably seen 3 to 4 decreases in the past 15 months with Lincoln's MoneyGuard. And the most recent one coming into play January 22nd of this month, they're going to take their MoneyGuard Fixed Advantage and they're going to have a decrease in the specific age bracket 40 through 70. Their issue ages are 40 through 80. So pretty much all their ages except for the higher age group. And that's going to be 0 to 22% with an average of 15% decrease. And that's key for this product with Lincoln MoneyGuard because they've had a few decreases kind of in the 0 to 12, 0 to 15. So adding one more is really going to help them position their pricing much better. And you're going to see more leverage in those clients' long-term care benefits. MoneyGuard 2, which is their California version of the product, we're going to see, pardon my arrow, a little out of place there. We're going to see that decrease at 12% for all issue ages across the board. So 40 through 80 for California will have a 12% consistent pricing decrease. COVID guidelines. Now, COVID still around, obviously. This is not something new. Carriers put these in place when COVID first came about. And then most of those guidelines kind of subsided with the exception of One America. They have a formal guideline in place, and that is anyone age 70 and above needs to be standard or better. Now, to understand how these products, get issued with ratings, et cetera, they typically don't issue. We have one they typically don't rate these policies at issue with the exception of One America. So if somebody applies, they're going to get issued as applied for with the couple's discount or at the single rates, as long as they're up to 4 medical tables. So they can have medical history, they can have high cholesterol, they can have blood pressure, they can even have some heart history. But as long as they're within 4 medical tables, think life insurance rating up to 4 medical tables, the carriers are going to issue as applied for. And our caveat or outlier, again, is One America. And right now we have to just be cognizant that anyone age 70 above, they're asking to be standard or better through the COVID guideline. Anyone who's had COVID in the past, we want to pre-qualify them if we can. There's residual symptoms that are concerning to the carriers, for example, severe arthritic hands or feet, to the effect that that client can't walk and they need help with daily living activities. A friend of mine got severe arthritic hand conditions. He's over age 70. He could no longer drive for 3 months, and it lasted a period of 7 months. So some residual symptoms that clients might be getting treated for can be of concern. So make sure you do a pre-qualify inquiry to Ashley or myself. It's a pretty simple process. We don't need medical records. We just need a write-up: height, weight, date of diagnosis, conditions, and treatment. And of course, the more that we get listed medications, et cetera, always helps help us pre-qualify and get that positive feedback from an underwriting to move forward, or perhaps to not move forward with an application. Now, the fun stuff for today, I want to talk about long-term care legislation. For any of you out there who may be positioning this product, familiar with it, you may know what happened in the state of Washington. Washington became the first state to implement a mandated long-term care statewide program among Washingtonians via a payroll tax. This payroll tax only applies to people 18 and above and who are W-2 income earners in the state of Washington. Now, I say that, keep in mind, the tax amount was 58 cents for every $100 of W-2 income. So for those income earners who are making, the higher income, 400,000, 500, your attorneys, your executives, business owners, and they're taking a W-2 income. This is where a lot of policies were sold in the marketplace because they were allowed what we call an opt-out provision. So some clients got in quick enough, they heard about what was going on, and they were able to get out of the tax by buying a private long-term care plan that is what we call Section 7702B coded. It's considered a qualified long-term care contract by IRS guideline, and they were able to opt out of this tax. But a total of 450,000 policies were sold in the state of Washington in 12 months, whatever the duration of the total opt-out provision period was, because I believe it changed or was revised along the way. So keep that in mind, because rolling forward, several states have raised an eyebrow since this passed a mandated payroll tax. And the next state that's closest to passing another mandated long-term care payroll tax to fund a statewide program is the state of California, which we're going to jump into. But real quickly, just some key bullet points. The Washington CARES Fund and what happened there, to me, was sort of a nightmare, because even though they offered the opt-out window, which ended up being October 1st to December 31st of October 1st, 2021 to December 31st, 2022, there was so much pushback that had changed along the way. So, people could get out of it, but not everyone gets educated in time to know about it and have time to make the decision. So unfortunately, the insurance companies were over capacity as applications started coming in, and they turned off the faucet midstream. They could not handle the business, and thousands of people did get shut out. So I say that because I think there's lost opportunity in talking about the importance of a long-term care legislation coming to the various states and having the conversation early instead of later. So as clients get more educated around this, it's a much easier conversation and not a panic mode, if you will. You got to scramble now because we have a short opt-out window. So anyways, another reason to be talking about long-term care is because of what happened in Washington. Now, when we look at the state map here, these are states that are either, if you can read the small print here, they're in a wait and see approach, which is the majority of the states, as you will see. My state, Nevada here, have not actively done anything yet, which I'm grateful for, but it doesn't mean it won't happen if we see another state move forward like California, who's the closest to passing the next mandated long-term care program. We've got the pink states, Minnesota, Michigan, Illinois. They are in the study phase. In fact, Michigan finished theirs this past year. And although it wasn't as long as a study that I have seen in the past, that study is available for review. It's published. If you'd like to see it, I can get that out as follow-up to see what they look like and what they're looking at in the state of Minnesota. I'm sorry, I misspoke. I said wait and see approach. The gray states, wait and see approach would be your red states. The gray states are not actively doing anything at all. So let's just say these red states are those states that are raising an eyebrow and maybe thinking about doing something. There's states who have proposed bills, right? A phase needed and a process to go through before it can come fruition to legislation. So that's Pennsylvania, New York. And I believe that little state there is that part of New Jersey? I'm not sure. I don't know if you can tell, Ashley, but I believe there was 3 states that proposed bills. So just be aware, states are looking at this. Some are more ahead of others in the study phase. Some are, a couple are proposing bills. Once we see California, if they move forward, then I think the activity and the momentum across the states will pick up. But as it stands right now in the state of California, there was a final feasibility report that was delivered with the recommendations to the California governor on January 1st of this year. So it's only been on his desk for, under 2 weeks. So haven't heard any feedback yet on where that's at, if it's being looked at or will be looked at after first quarter, because we're in an election year. We don't know what the timeline is for the governor to actually review it. Just know briefly, there were 5 proposed plans in that proposal that went before the governor. Anywhere from plan 1, which is the bare minimum coverage. So probably the lowest tax on someone's payroll, if you will, for plan 1. And I believe the starting tax was 40 cents for every $100 of W-2 income. But keep in mind, self-employed individuals are going to be included. So they don't have to have a W-2. The business owner is taking income a different route than a W-2. They can still be pulled into this payroll tax. So independent contractors will be pulled into the tax. So 40 cents per $100 of W-2 income for the basic plan. And when I say basic, I mean no nursing home care, no skilled care, no home health care type benefits. I'm talking Meals on Wheels, transportation reimbursement type services, very basic. It's not really a long-term care plan, in my personal opinion, when there's bare bones coverage in that with a fraction of what's really needed, $36,000 max in that plan. Plan 2, larger plan, $110,400 or $46 per month in benefits, and these are both are 2-year durations. So a little more than your basic plan. You can get home health care coverage here or skilled care. Same with plan 3, which is what I call more comprehensive. It's a smaller benefit, but they're going to pay $3,000 a month for 1 year. And as you can see, the plans just vary drastically. They vary. $81,000 or $4,500 a month. Plan 4, with the most robust plan and benefits being plan 5, $144,000 or $6,000 per month. To me, that would be a minimum to recommend if I'm having a conversation and I'm talking about long-term care legislation being a factor in that conversation. I would recommend that as a minimum. Just our opinion of where we stand on this here at AIN. So will the governor approve Plan 1, Plan 1, 2, and 3? We don't really know. He could say Plan 1 for the bare bones and maybe the maximum Plan 5. But again, we don't know. It's proposed, meaning that if advisors are comfortable talking about this, which I feel they certainly should be, because clients need to be educated yesterday, not today, but they need to be educated on this. And I think it's, it's safe to talk about it as long as we do not talk about this with any certainty. It's for sure going to happen. You have to act now. That's the stuff that stemmed a warning letter from the Department of Insurance in California, because there were a particular advisor or advisors who were stating this as matter of fact, going to happen tomorrow, and you need to do this now. So that's my only feedback I would give you for an advisor, if they want to talk about this, to make sure that it's talked about as a proposed legislation. All right, opt-out provision. There's definitely language in the final feasibility report, and I have a copy of this for you, and or a live recording of the last meeting where they kind of talked to certain pieces of this proposed legislation. So happy to get that out to you as well. But just know, with an opt-out, even though nothing's final, the type of contract is to be determined. You'll see TBD in that feasibility report. Just know that we can take away what we learned from Washington. You want clients in a qualified long-term care contract, which is the 7702B contract I mentioned earlier. And that does include a life policy with a long-term care rider, not a chronic illness rider, but an LTC rider, a traditional long-term care plan, or any asset-based long-term care plan, life component or annuity component chassis plan that I showed you earlier, are all going to have that section 7702B coding. So that's what we have to work with. We could only move forward and have conversations around with what we learned in Washington, and this is what they allowed for in the Washington plan. This just kind of covers some bullet points on the opt-out window. There was some language, and I wouldn't give this heavyweight right now, on the opt-out window that was going to be, this or that. It's going to be the program's effective date, January 1, 2025. So if it got approved, say, October 1st of this year, that gives us what? A 3-month window for an opt-out. Not a really long time, considering what will happen in the insurance industry and insurance companies getting overcapacitated with applications. This is the October 1, 2024 date I just gave. The Senate pass date, if it's September 1st, depending on when it passes, is going to help us determine when that actual opt-out period looks like. So another unknown, but in the final feasibility report, they were talking about it being the 1st of January following the governor's approval. So again, if he approves on October 1st of this year, the following January 1st would be January 1st, 2025. That's a 90-day opt-out. But we'll see where it lands, because the governor can say, I don't like this, I can change it. We don't know. So in terms of opt-out, think of it as, yes, highly potential we'll have it, but let's not plan on it being long. That would be my advice in planning forward. There's a note here, opt-out window likely closes December 31st, 2023. That was based on all the different bullet points that they had pointed out, right? But again, we really don't know until the governor approves and makes any recommended edits in this program. Now let's talk about the opportunity, because I did mention 450,000 was probably over that policies being sold in the state of Washington. The size of Washington is probably 4 times less than the state of, excuse me, forgot to silence my phone. Four times smaller than the state of California. So with that, we have a significant population. with W-2 employees and independent contractors being pulled into a potential tax. And with that, the opportunity in terms of the types of strategies that we can be talking about with advisors and clients is that these products, because they are Section 7702B coded as a qualified LTC contract, that means there's eligibility for tax deductions for business owners and even individuals. Individuals must itemize and be over 7.5% of AGI to qualify for a deduction. So keep that in mind for individual clients, but for businesses, the deduction is considered a health insurance deduction. And 3 out of 4 of our carriers who have the life component asset-based long-term care plans will break down. They'll break down the that premium for you. They're going to break down the health insurance, which is called the long-term care premium or the long-term care rider or inflation rider premium. They will break it down in the illustration so an advisor can easily see what that health insurance deductibility amount would be, and they can use that number for a tax deduction. And they separate the other premium, which is called the life portion of the premium. And we're working on a case now. Ideal group for me for asset-based long-term care planning is the smaller groups, say under 50. Our carriers will do list bill on the asset-based side. So keep that in mind. I think there's like a minimum of 3 policies, ideally. So whether the plan is a volunteer plan where employer doesn't want to pay the premiums, but will allow and coordinate and set up the plan for employees pay the premium. There's so many different ways we can go in this planning process, but the ideal group for me for asset-based long-term care plans would be 50 and under. Not that it can't be bigger, but it's just different. We have other avenues using life insurance with long-term care premiums that are true group design contracts by our life carriers. So that's another opportunity. But because those are life contracts, that may knock them out of a tax deduction. The tax deduction applies really to the asset-based long-term care plans, but there's just different options or different directions we can go to depending on the logistics of your plan and your group size and the type of business they are. 2% or more owner employee, that's going to make a difference on tax deductibility. Also, depending on the type of business entity they are, C Corp, S Corp, pass-through entity, makes a difference on that tax deductibility. So we're not going to dive into that today because that's a more in-depth conversation. But just know you have tax advantage strategies going forward. The one here I mentioned, Pension Protection Act strategy, this is using the annuity. I only saw these come into play in Washington when we were getting close to that window where there wasn't much time for underwriting, because the annuities do have more simplified underwriting and they're quicker to get through the system. We did see people coming in with small single premiums to the tune of $35,000 being the minimum from one of our carriers, and setting up that asset-based long-term care annuity as a last-minute strategy to put some coverage in place for their clients. So it's a great strategy because someone sitting on a non-qualified annuity can 1035 exchange that into a 7702B LTC annuity of the carriers that I showed you earlier. And any gains in that contract that come through are going to come out tax-free as long as those benefits are coming out and paying for the long-term care. All you're doing is repositioning an existing annuity, putting it into a qualified long-term care asset-based annuity. Every dollar comes out tax-free. I don't care if there's a $10,000 gain or a $50,000 gain or higher. That's the tax saving strategy we have using the asset-based long-term care annuities. Qualified funds, these are another opportunity to position. Because they're qualified money, we can't always get away from the tax, but we have a strategy to spread out any taxes for clients over 10 to 20 years and really making that a feasible strategy for clients. So I've given you a lot of information. We're going to go to a quick Q&A. I don't know if anyone has checked the box, but I see one from Nicole. Are the proposed plans reimbursement or indemnity? Great question, Nicole. The plans are both. We have a combination of amongst the carriers I showed you. I believe 2 reimbursement on the life component plans and 2 indemnity. And on the annuity asset-based plans, they are both reimbursement model plans. So combination of both. And those are 2 different models that to me are both advantageous. It all depends on the needs and the importance for the client in that planning.
Hey, Alana, building upon Nicole's question, what about for these proposed plans for the actual state? How does do you know how the state intends to have these claims paid?
When you say the state for the legislation,
Correct, right. So if I'm paying in X dollars per 100 I make,
right?
and if I go on claim, do I have to get reimbursed to get that from the state, or
It is, I'm 99% sure it is it's going to be a reimbursement. And how that claims process is going to look like, I don't know. I mean, that's a great question. If anyone has had a state provided plan in place and had to file a claim, they could probably speak to this. But, you know, in hindsight, when we look at a claims process, whether it's your car insurance, your life insurance, long-term care insurance, it's never fun. It's never, you know, a 1, 2, 3 step and you're getting your benefit check, right? There's claim paperwork. There might be communications with your doctors to make sure you have your long-term care plan in place, what they call a plan of care that triggers the benefits to be paid. Then your benefits start coming on an asset-based long-term care plan. That to me is easy. 1, 2, it's got to be 1, 2, 3. But again, I don't know what the state is going to make that claims process look like. I think there might be some verbiage on it. I'll send out the final feasibility report to Ashley to share with the group. But if you open that report up, should be a box on the top that says search. You can actually search keywords and it'll give you every instance in that feasibility and recommendations by the California Task Force. And you can kind of find that wording and see if there's any instruction on how those claims will look like or how they pay. Okay. My guess is it's not going to be too detailed if there's any, but I could be wrong. So I'll leave you with that.
It's definitely something that I hadn't heard about and kind of had thought about on my own side. The other thing that I would say about this legislation, and exactly, guys, I just kind of want to harp back on what Elena said. You know, we found out about the Washington state legislation and it almost was like a little bit too late because the carriers were flooded with applications. And a couple days later, we got the notification, we're not taking any cases for Washington. So, and pretty much all the carriers fell in line with that very, very quickly. So, you know, if you see your state or states that you have significant amount of clients in that are looking at this, considering it, it's going to the governor's desk for a potential right into the state law, this is something you're going to want to have conversations with your clients before you get to that point where they say, okay, we know what the end date deadline is. Because you know, we saw it once before, we'll see it again when the next state approves this legislative tax, and it's going to be a run on the insurance carriers for a policy, basically.
Right. And to me, it's a great conversation starter, right? You're educating your client. I know for me, if I was going to get hit with a payroll tax, I want to hear about it from my advisors. I don't want to hear about it through TV commercial. I don't want to hear about it in the newspaper. But I think this is an opportunity to educate the public, if you will, and take advantage of that and have that long-term care conversation for those clients who can use some long-term care planning. It's just another factor to throw in there, not the sole reason we would be planning, right? But if you ask that to somebody who's making 500,000, it could be the sole reason you want to talk to them. They might want to get out of it, just and put the minimum coverage in place. But comprehensive planning conversation is great now. Yes, Ash.
One other thing, for small businesses, let's say, for example, one of our attendees here has maybe a business owner that, I don't know, maybe has 10 people in his company out in California. How, is there a way to do something like a list bill for a small business where the employer can say, yes, this is something I want my employees to be knowledgeable on, and I want to give them the opportunity to get a policy in this manner.
Yes, and I think I mentioned that the minimum would be probably around 3 on a list bill. So if it's a volunteer plan where the employer says, I'll put this together and be, sponsor, if you will, but I'm not gonna pay all your premiums. You're gonna pay some or all. Yeah, I mean, 10 would work, particularly for the asset-based long-term care plans. When we look to a true group outside of asset-based long-term care, like life insurance using a long-term care rider, those group policies, for example, John Hancock has put one together. They're gonna have their group criteria, 100,000 salary, everyone in the group minimum, or X number of people. So there's different criteria depending which route that we can go. And a group size of 10 would work well for the asset-based long-term care plans.
Wonderful.